Silver just punched through critical resistance, and it's not because of some short-term rally or headline news. In the last trading week alone, COMEX Vaults have shed over 10 million ounces of registered silver supply, the fastest drawdown we've seen in years. Prices are trading near the mid-$90s levels, not seen in over a decade, and buyers aren't just paper traders anymore. Physical demand is ripping through inventories, ETFs are gobbling ounces at record clip, and what was once a quiet corner of the metals complex is now looking like the epicenter of a precious metals squeeze. Today we're unpacking what just happened, why it matters, and where this could be headed next. Let's get into it. Last week something happened in the silver market that rarely occurs outside of crisis conditions. Registered inventories on the New York Mercantile Exchange dropped by more than 10 million ounces in a single week. To put that in perspective, that's roughly enough silver to supply the annual industrial demand of a small nation. Prices responded immediately. Silver rallied from around $88/Oz to the high $90s, briefly testing levels not seen since the early 2010s. Meanwhile, the market's bid-ask spread widened and volatility spiked, not the hallmark of a sleepy metals market, but of one where supply and demand fundamentals are beginning to strain. On the exchange front, data shows that traders withdrew tons of registered silver, the kind eligible for delivery, faster than any recent comparable period. At the same time, COMEX open interest has climbed, suggesting both longs and shorts are repositioning aggressively. So what exactly is driving this? Let's break down the structure of the market to understand why this is more than a simple headline rally. Futures markets. In the futures world, silver has a dual identity. It's both a speculation vehicle and a hedge against macroeconomic uncertainty. The contract sits on COMEX, where traders can go long, short, or arbitrage between months. What's notable right now is that open interest, the total number of outstanding futures contracts, has been climbing even as prices rise. This tells us the move isn't just a quick squeeze of weak hands. New positions are being built, bullish speculators are entering, and seasoned traders are still willing to put capital to work on both sides of the tape. But here's the key: futures are paper claims on metal, not the metal itself. And that distinction is becoming central. Physical supply, registered COMEX inventories, track the silver that is actually available for delivery into a futures contract. When that supply dries up, the path from paper positions to physical metal becomes strained. The 10 million ounce drawdown wasn't random. It coincided with significant withdrawals from physical bullion trusts and ETF products, where holders are redeeming or accumulating actual ounces. That physical demand is not reflected in the same way in futures pricing, at least not yet. Technical levels. From a technical standpoint, prices have broken key resistance zones around $92. We're now testing the next cluster around $98, $100, which was historically a major pivot area in prior cycles. Momentum indicators like the RSI have entered overbought territory, not necessarily bearish, but suggesting strong conviction among buyers. Institutional positioning. Commitments of traders data shows managed money accounts increasing long exposure, while commercials, the so-called smart money hedgers, are lightening shorts. When commercials reduce short positioning and trend participants load up on longs, that's a dynamic you don't ignore. This isn't happening in a vacuum. Several global forces are intersecting right now and driving both demand and sentiment. Federal Reserve policy, with inflation still stubbornly above target in many major economies, real yields remain low or negative. That environment historically boosts demand for real assets like precious metals, particularly silver, which trades as both a commodity and a monetary proxy. Inflation and currency pressure. The US dollar has shown periodic weakness, particularly against currencies experiencing instability. When the dollar weakens, dollar-priced commodities like silver often gain upward traction as global buyers seek stores of value. Geopolitical tension, ongoing global supply chain disruptions and geopolitical flashpoints make physical metal appealing not just to speculators, but to institutions seeking safe haven diversification. Industrial demand. Silver has unique industrial use, from photovoltaics to electronics, meaning it faces real demand even beyond monetary speculation. Any uptick in global manufacturing furthers that pull on inventories. These macro drivers aren't just background noise, they're feeding into real capital flows. Now let's make a crucial distinction that too many casual observers miss. Paper silver versus physical silver. Paper silver. This is what you trade on exchanges. Futures contracts, options, ETFs, instruments that represent silver or promise settlement. Most traders will never take delivery. They enter and exit positions based purely on expectation of price movement. Physical silver. This is the metal you can hold in your hand, bars, coins, allocated bullion, tangible ounces that exist outside of any financial contract. Why does this matter? Because right now there is a divergence forming between paper and physical markets. Paper positioning has been bullish for months, but physical demand, evidenced by shrinking exchange inventories and rising premium on physical settlement, is growing faster than expected. That kind of divergence can lead to real squeezes when the paper market tries to convert into physical delivery, something historically seen in commodities like oil and agricultural goods during supply stress. We saw hints of this in the gold market during past crises, but silver's physical market is much smaller, meaning it takes less volume to strain available supply. Let's look back. In 2011, silver spiked toward $50/Oz on a combination of speculative fervor and physical demand. ETFs were accumulating massive amounts of metal, and physical premiums rose sharply as inventories tightened. COMEX inventory drawdowns were a key feature of that move. Fast forward to 2020, during the early COVID market shock, we saw a crash and then a recovery, where physical demand surged even as futures markets whipsawed, again showing that paper price and physical supply can diverge sharply. Today's environment has echoes of both episodes: strong macro drivers fueling speculative positioning, paired with real physical demand that's actually pulling metal out of the system. But remember, this time prices are near all-time nominal highs for silver, and supply drawdowns are occurring faster than many expected. Bearish scenario: why prices could fall? Let's play devil's advocate. Liquidity squeeze. If global liquidity tightens sharply, guru surprise rate hikes or credit tightening, risk assets across the board can sell off, including commodities like silver. Profit taking. After a strong move, short-term traders may liquidate positions, driving volatility and temporary downward pressure. Physical premium normalizes. If physical premiums pull back and inventories stabilize, the paper market could decouple again, reducing upward pressure on the cash price. Dollar rebound. A stronger dollar driven by macro shifts could weigh on dollar-priced commodities. None of these are certainties, but they are real risks that keep the market honest. Bullish scenario. What could trigger a major rally? Now the flip side, further inventory drawdowns. If registered COMEX inventories continue to shrink and withdrawals into physical ETFs or private vaults accelerate, that tightness can morph into a squeeze where paper holders are forced to chase metal. Inflation reacceleration. Renewed inflation pressure, domestically or globally, can drive safe haven demand back into precious metals. Geopolitical shock. A sudden shock to industrial supply chains or major currency instability could push investors toward physical metals as a store of value. Delivery demands spike. If futures traders begin demanding deliveries to cover positions, a rare but explosive catalyst that can rapidly pressure available inventories. This is the scenario that would turn a strong move into a historic run. These are the metrics the most sophisticated market participants are watching. Price levels: support $88 per ounce. Near-term pivot: $92, $94 per ounce. Resistance cluster: $98. Psychological target: triple digits inventory metrics. COMEX registered silver, trending toward multi-year lows. Total exchange inventories, shrinking quarter after quarter. ETF flows, net inflows into major silver ETP products. Redemption versus creation data for funds. Open interest dynamics. Rising open interest alongside price increases, positioning shifts between commercials and managed money. Physical premiums, premiums on coins and bars, delays or backlogs in mint fulfillment. These data points aren't speculative, they're the backbone of market structure. Supply is tightening. COMEX registered inventories have plunged, a clear signal of growing physical demand and shrinking readily deliverable supply. Paper and physical are diverging. Futures positioning is bullish, but real metal withdrawal from exchanges tells a deeper story of tightening fundamentals. Macro conditions amplify risk and reward. Inflation dynamics, currency pressures, and geopolitical uncertainty are adding fuel to both speculative and physical demand for silver. So what does this all mean? We're not just watching a price chart go up, we're observing a dynamic interplay between supply, demand, macro forces and market psychology. That interplay is fast evolving, and the drawdown of millions of ounces from COMEX vaults could be a prelude to a much larger structural change in the silver market. This isn't about hype, it's about understanding why this market is moving, who is demanding metal, and what could happen if supply continues to tighten while macro pressures persist. Stay tuned to the data, watch the inventories, and always think in terms of structure, not noise. Thanks for watching, and I'll see you in the next analysis. Goodbye, bro.